While we wait for the next wave of work, companies pivot to serve a thinner wallet. And that pivot becomes the business model of an era. The low-income business model, when consumers get poor. When firms accept that wallets are thinner, they don't pause. They pivot. Walk into a dollar format store on a Tuesday morning. The parking lot's full because payday cycles no longer anchor shopping. People come when the card clears. Inside, unit sizes shrink. 12-ounce cereal replaces the old pound box. The sticker price stays friendly. The cost per ounce quietly climbs. It works because it meets the new math of the household, small cash outlays, even if the long run is worse. Shrinkflation spreads beyond groceries. A family-sized detergent bottle turns into a curved plastic illusion, less liquid inside, same shelf space. The label adds concentrated, which might be true, but the purpose is clear. Keep the price point stable as budgets wobble. Businesses start to think in thresholds, not value. What can clear at $4.99, at $9.99, at $19.99? The goal isn't abundance, it's survivable decisions. Subscriptions fill the gaps. Instead of one $300 suite, you get 5 micro-subscriptions at $3.99 each tied to a single feature that used to be bundled. Users hold on because canceling one tool breaks a workflow, or a school login, or a kid's game with sunk time. In aggregate, the small becomes large, but each charge is too small to fight. Companies learn a cadence: free trial, upgrade nudge, downgrade friction. Revenue stabilizes on attention more than income. Ad-supported free layers bloom. Streaming with ads, apps with ads, games with loot boxes, news behind engagement walls. The product becomes you. The minutes you can give, the clicks you'll trade to avoid paying. As money thins, attention becomes the commodity, and design leans into extraction. Autoplay, infinite scroll, reward streaks. It doesn't feel like spending, but it redirects hours you might have used elsewhere into the machine that monetizes your gaze. Lotteries and gambling find their moment. When upward paths feel narrow, the appeal of a windfall grows. Scratch-off aisles widen. Sports betting apps offer risk-free bonuses that aren't free. Casinos open near towns that lost logistics shifts. It's framed as entertainment, and for many it is, but for some it's a budget strategy born of exhaustion. When you can't save your way to stability, you spin for it. Housing splits along a sharp line. Luxury towers rise downtown with amenities that photograph well. Roof decks, cold plunge, pet spas. Rents target the upper slice of earners and asset-rich downsizers. At the other end, substandard rentals persist. Fees layered on, application fees, pet fees, valet trash, convenience charges for online payments. Build-to-rent empires scale single-family homes at institutional prices, standardizing leases across regions. The middle, starter homes financed by rising wages, thins out. Healthcare and education follow a similar arc. If incomes can't carry price tags, finance fills the space. Student loans stretch degrees across decades. Payment plans and medical credit lines cover deductibles that jumped while wages stalled. Providers adopt revenue cycle software tuned to capture every reimbursable code. Colleges spin micro-credentials and certificates on subscription. The demand looks steady because the bill shifted forward, not because the buyer got stronger. There's a trap here. These models are profitable. They show up as wins in quarterly reports. Lower-income customers are extremely loyal because switching is hard and options are few. But the loyalty is really lock-in. Over time, the ecosystem corrodes the very base it depends on: attention drained by ads, budgets siphoned by fees, future paychecks pre-spent to keep today afloat. The market survives by designing around scarcity rather than reducing it. A renter's month tells the story. She's on a 12-month lease with a smart home, fee she didn't want, a pet rent that isn't a deposit, and a $75 charge for covered parking that used to be included. Her phone plan is bundled with streaming she barely uses, but canceling raises the phone bill. Groceries come from 3 stores because she's chasing discounts that rotate weekly. Healthcare is 2 telehealth subscriptions, cheaper than urgent care, good enough for refills. She pays for cloud storage because her photos matter, and a game pass for her son because it's cheaper than new titles. Every line item is defensible. Together, they grind. For businesses, the strategic shift looks rational. When your customers have less money, you unbundle, you segment, you mine the long tail. You build ad-supported tiers to keep usage alive, You sell essentials at low prices and move margins to accessories. You optimize price discrimination with data. You avoid being the big expense by becoming many small ones. The spreadsheet applauds. The town doesn't. Policy tries patches. Tax credits arrive in spring and vanish by summer. One-time checks make a dent, then inflation nibbles them away. Stimulus can float a quarter, even a year, but the underlying customer is still poorer when the music stops. Companies that grew fat on the free layer and microcharges can't flip back to full price overnight. The model is set. This is the quiet redesign no one voted on. Not a plan, but a drift. The economy orients around making poverty livable, not making prosperity likely. It's stable for a while, stable like a chair with one leg repaired with tape. And when the next shock hits, tape isn't enough. So policy steps in again, louder this time, because Band-Aids can't rebuild a paycheck. Stimulus, QE, and the fake recovery high. Policy doesn't ignore a thinning buyer base. It does what it can do fast, send money and lower rates. During the pandemic, governments tried a radical experiment at scale. They told people to stay home, then wired cash anyway. Payroll support, enhanced unemployment, direct checks, child credits. The goal wasn't growth, it was survival. And for a moment, it worked. Demand didn't collapse. Grocery aisles cleared. Rent got paid. A small shop that would have closed in April stayed open into winter because customers still had cash to spend on curbside pickups and gift cards. On the central bank side, quantitative easing reopened frozen pipes. Buy bonds, compress yields, make mortgages cheaper, keep credit card APRs from spiking into panic. Liquidity flooded markets. Asset prices levitated. A strange split appeared. Wall Street soared while Main Street taped arrows to floors. Your index funds smiled through a mask. Your neighbor delivered takeout to keep the lights on. The short-run success was real. Transfers landed quickly. Poverty measures dipped. Delinquencies fell. For the first time in years, many households saw a checking balance that didn't spark dread. Some paid down cards. Some started tiny savings for the first time. The lesson looked simple. When the loop stalls, you can push income directly into it and keep the flywheel turning. Then the hangover arrived. Savings buffers faded as work hours stayed uneven and prices climbed. Supply snarls and stimulus collided. Goods demand surged into strained ports and thin inventories. Prices jumped, first in cars and appliances, then across baskets. The relief checks that felt generous in March felt small by December because rent rose, groceries crept, and service fees multiplied. Wages rose in some sectors, but unevenly and not always ahead of inflation. The cash that bought time didn't buy a new equilibrium. QE carried its own side effects. Low rates and asset purchases juiced valuations. Housing took off. For owners, paper wealth swelled. For renters, the path to ownership moved further away. Stocks posted records while gig workers stitched multiple apps together to hit last year's income. The asset-income gap widened, and with it the sense that policy had stabilized prices more than lives. Politically, patience frayed. Emergency transfers are popular when sirens are loud. They get complicated when the emergency lingers and sticker shock shows up at the pump and the checkout. Coalitions that supported one-time checks balked at making them permanent. Legislatures split over whether sustained aid invited inflation or simply recognized a new baseline. Households heard the argument and shrugged. They felt the rent due date. They watched groceries ring higher than last month. Underneath, the lesson hardened. Money buys time. It doesn't fix the decoupling between wages and demand. You can patch the income side temporarily with public funds, but unless the wage mass recovers or a new income stream replaces it, the economy tilts back to the same problem once the transfers fade. The loop needs a steady oxygen supply. Tanks work in a crisis. You can't live on a tank. A microstory makes it plain. A neighborhood cafe lost its lunch rush when offices went remote. Stimulus checks and PPP helped them pivot. Bagged breakfasts, patio seating, gift cards that regulars bought to keep staff paid. It stretched into the next season. Then the checks ended, office traffic stayed low, and ingredient costs rose. The shop cut hours and menu items. Loyal customers still came, but fewer and with slimmer orders. By spring, the owner faced a choice: raise prices and lose volume, or hold prices and drain savings. The policy bridge had worked. The other side wasn't built. Critics say inflation proved the aid was too big. Maybe partly. But the structural issue predates the crisis. Automation and bargaining shifts had been thinning paychecks for years. The pandemic exposed it by forcing a live-fire test of income replacement. When the support turned off, the old imbalance reappeared. That's not an indictment of help. It's a diagnosis of reliance. Emergency money asked to do structural work will always disappoint on the second lap. Markets took their cues from the sugar high. Retailers overordered into stimulus demand and then hit the air pocket. Clearance racks multiplied. Warehouses filled. Discounts plugged the hole for a quarter and trained customers to wait for sales. Investors rotated from growth at any price to profits now, punishing firms that had mistaken temporary demand for a permanent step-up. The correction wasn't just about multiples. It was about misreading a one-time infusion as a trend. Policymakers learned selectively. Automatic stabilizers, like enhanced benefits tied to unemployment rates, look smarter than ad hoc votes. Timely, targeted, and temporary makes sense when the shock is clear. But when the shock is structural, productivity gains captured by capital while labor's share slips, the tools need to evolve. Otherwise, each crisis demands a larger check for a shorter effect. So the experiment leaves us here. We know cash can sustain demand when work can't. We know QE can calm markets and lower borrowing costs. We also know neither rewires the incentives that push firms toward fewer employees per dollar of output. The fake recovery high isn't that stimulus didn't work. It's that it looked like a cure when it was a pause. To stay upright, we need architecture, not adrenaline. And that's where the next acts turn, from patches to design. The fixes, Part 1, wage and work reforms. We've tried adrenaline. Now we test architecture. Start with the oldest lever in the toolkit, wages. Minimums anchor the floor, but static floors sag under moving ceilings. One approach ties wage floors to productivity or profits, a dynamic minimum that rides the economy's real gains. If output per worker rises 10%, the wage floor ratchets up automatically. No waiting for politics. It won't turn every job into a career, but it restores the link the loop depends on. When the pie grows, slices do too. There's a risk. If you force pay up while firms can still swap humans for machines, you could accelerate substitution. That's where design matters. A dynamic wage paired with incentives that reward human employment and the diffusion of tooling. Co-pilots for clerks, not just headcount cuts. Keeps the focus on augmentation, not replacement. Indexing to sector productivity avoids punishing low-margin services with the same bar as superstar tech. Next lever, ownership. If labor's share shrinks, give labor a stake in capital's rise. ESOPs are one path. Employees earn shares that vest with tenure, building wealth as the firm grows. Broad-based equity plans take the tech model. Stock to everyone, not just executives, and normalize it across industries. Profit-sharing pushes gains out as cash, not just options. The mechanics vary, bonuses tied to margin, quarterly distributions based on a formula, but the principle is blunt. When efficiency gains arrive, workers see them as income, not just read about them in filings. These plans aren't charity. Companies with profit sharing often see lower turnover, tighter alignment, and a culture that spots waste early because everyone's bonus rides on it. The design challenge is scope. Narrow plans decay into perks for a small core. Broad plans change household budgets. That's the target. A line worker who counts on a quarterly check spends differently. A nurse who knows a year-end pool rewards throughput and quality leans into better workflows. The loop thickens because income becomes partly countercyclical to hourly cuts. Benefits are the third pillar. Tying healthcare and retirement to a single employer made sense when careers were linear. Today's churn turns benefits into cliffs. Portable benefits follow the worker. Health coverage, paid leave accruals, retirement contributions that flow through gigs, contracts, and part-time roles. An independent fund, funded by modest contributions from each hiring entity proportional to hours or income, smooths what the market now makes jagged. That way, a month of reduced hours isn't a health coverage crisis, and a jump between employers doesn't zero out earned leave. Stability keeps demand steady. Time is a lever we underuse. Work time reduction, 4-day weeks, 30-hour norms, spreads available work across more people without cutting weekly income. Pilots show steady or higher productivity per hour, lower burnout, and flat output with fewer mistakes. The math is delicate. You can't ask a firm to pay the same for less if output collapses. But if AI lifts individual throughput, banking some of that gain as time, not layoffs, turns efficiency into social resilience. Households get a day back, care, retraining, rest. The economy gains buyers who aren't exhausted and can actually spend. To make that choice competitive, align incentives. Right now, tax codes often favor machines over people. Depreciation schedules let you recover the cost of equipment quickly. Payroll taxes compound endlessly. Robot taxes are one provocative label. Payroll parity is the quieter fix. Level the after-tax cost of $1 to a worker versus $1 to a machine doing the same function. For example, let firms deduct refundable credits when they retain or reassign workers displaced by automation and invest in training that raises their wage band. Or stretch equipment depreciation in contexts where substitution threatens local employment without offsetting plans. Guard against clumsy outcomes. If you tax robots, firms will rename them software licenses. Better to define parity around the outcome. When a technology reduces labor demand for core tasks, the firm must either share gains through wages, profit sharing, or time, or contribute to a pooled fund that finances training and income support in the affected region. Carrots first. Credits for firms that can show wage-indexed gains or reduced hours with stable pay. Sticks only when the business model banks savings while offloading costs to the town. None of this works if workers can't climb. Training needs paychecks. On-the-job upskilling beats classroom-only promises. Structure it like an apprenticeship for the AI era. A paid track where employees move from task doers to system supervisors, from rote to quality, from entry to judgment. Employers get retention. Workers get a raise that reflects new leverage. Pair it with portable credentials, real assessments, not fluff, that travel across firms. The goal isn't certificates, it's bargaining power backed by skill. Will these reforms stop AI from compressing labor's share? No, they temper it. They turn one-way efficiency into a two-way street. They buy time for households to adapt without falling off a cliff, and they keep demand alive while supply engines rev. They also reveal the limit. Even with stronger floors, broader ownership, portable benefits, shorter weeks, and parity incentives, a world where small teams plus models outperform big teams without them still pushes wages toward a thinner base. That's the point of the next step. When jobs can't carry the entire demand load, income has to flow through another channel. The choice isn't between markets and transfers. It's between markets starved of customers and markets fed by a redesigned baseline. We've strengthened work. Next, we look beyond it. Income that arrives without a time card, with rules that keep prices sane and dignity intact. The Fixes Part 2. Income without jobs, UBI and beyond. If the paycheck can't carry the load, you need a second artery. Start with the cleanest version, a universal basic income. One flat cash payment to every adult, no forms, no means tests, no gimmicks. It stabilizes demand by guaranteeing that every cart has something in it, every month, regardless of a firm's staffing plan. The idea isn't theoretical anymore. City pilots showed reduced financial stress, better mental health, and higher job search intensity because people could afford to look for a good match instead of grabbing the first thing. Scale matters. A modest UBI, just enough to cover basics, doesn't erase work, it makes work selective. The grocery clerk can refuse a toxic schedule because the rent won't implode in a week. A freelance designer takes a risk on a client because the lights stay on if the invoice is slow. That bargaining shift puts a floor under wages in the low end and reduces exploitative churn. Demand steadies because households aren't falling through trapdoors every time hours wobble. An alternative with similar intent is a negative income tax. Think of it as an automatic top-up through the tax system. Below a certain earnings threshold, the government pays you instead of you paying taxes. As you earn more, the payment tapers. It's universal in eligibility but targeted by design, cheapening the total bill relative to a full UBI while still building a reliable base of spending where it's most needed. Earned income credits are the cousin we already know. Expanding and smoothing them monthly, not yearly, turns them into a quasi-UBI with work incentives intact. The criticism lands fast. How do you pay for it? One answer is to tax what's growing. A value-added tax on AI-amplified outputs spreads the burden across the consumption enabled by automation. Small rates raise real money precisely because the base is broad: software subscriptions, ad stack platforms, AI-augmented services.